Hello and welcome to Trust and Estates Weekly. I'm your host, Kevin Bemmel, and we're here every Monday at 10 a.m. Pacific Time to talk about all those matters related to estate planning and administration, as well as trust administration, and from your personal planning perspective, as well as being a professional who helps people with these matters. And today, for those of you who are Wall Street Journal readers like me, there's been an interesting sort of confluence of events because my topic for today, estate tax planning, made it into the Wall Street Journal. It is interesting because as we get closer to the presidential election, the issue of estate taxation is a significant one. Excuse me, because of the candidates' very different positions on what's going to happen. So, and as you know, I don't do politics on my shows. So my purpose here is to explain the situation. I certainly have my view as to which is better, which I'll share for you. But I'm not looking to wade into the political morass. So, setting up some background, in 2017, when President Trump was president, he passed a tax reform. Well, not he. The Congress passed a tax reform bill, and there were a number of changes in that bill. One of which was a significant increase in the estate tax exemption. Now, as of this year, that exemption amounts to $13.61 million. So if the taxable value of an estate is less than that $13.61 million dollar value, no estate taxes, at least at the federal level, are levied on that estate. And by the way, if it's a married couple, so basically the exemption is doubled to $27.22 million. Okay. Now, the legislation that was passed in 2017 expires at the end of next year on December 31st, 2025. If it is not renewed in some way, at least if let's just say specifically the estate tax provision, if that's not renewed in some way, then the estate tax exemption will drop considerably. So the estate tax exemption for next year, 2025, is projected to be about $13.99 million, or what would amount to $27.98 million for a married couple. Okay, so almost $28 million. If there's no change in the 2017 legislation and it does expire on December 31st of next year, so it's projected that the exemption will drop to about $7 million or $14 million for a married couple, and that's about half of what it would be next year. In so doing, the number of estates subject to taxation would increase, or not would, but are projected to increase from about 4,000 or so this year and next to about 8,000 or 9,000. So more than double. Okay, now, if your estate is significantly less than $7 million, so you probably have nothing to worry about. Having said that, depending on who wins the presidency and which party which party controls Congress, the changes could be more than simply the 2017 tax legislation expiring. So if President Trump wins election, and Congress and Republicans win control of Congress. So one of the issues being discussed is that the estate tax, or what Republicans oftentimes call the death tax, would be completely eliminated. Okay, now exactly what that would look like, I don't know. Currently, when someone dies, the heirs get a step up in basis. So, for example, if when someone is alive, an asset an asset has a basis of, let's say, $100,000, and when he dies, the property is worth $1 million as of his date of death. So the heirs basis in that property will be $1 million. It will be stepped up to $1 million. Now, the justification for that step up historically was that since estates paid taxes, they were essentially paying taxes on the current value of the property. And so the heirs were entitled to a basis based on the current value, or at least the value as of date of death. If the estate tax is done away with, will that include heirs still getting a step up in basis, or will that mean that heirs will merely inherit an asset at the whatever the basis is currently on the books? Don't know, can't say. But that's one sort of end of it. That if Republicans control the government, the federal government, of course, we're talking about after. As of next year, then they may completely do away with the estate tax in whatever form that would take. The flip side is, if Kamala Harris wins the presidency and Democrats control Congress, so they may lower the estate tax exemption even more. So while it's projected to be around $7 million as of if the 2017 legislation expires, they may seek legislation in 2025 that would lower it even more than that. Maybe they would lower it to, who knows, $2 million, $5 million, something like that. We don't know. So from an estate tax provision, what happens in the election is important, because it almost for sure it's going to mean some kind of significant change from where we're at right now. The only well, I shouldn't even say the only situation. If there is some sort of divided government where one party controls the presidency and another party controls at least one house of Congress, so then it's very hard to say what will happen, because some kind of solution would have to be negotiated, and we all know how difficult that has been since we've faced divided government quite a bit over the last, whatever it's been, 10, 15 years. So it's very hard to say what's going to happen. So for those of us, or those of you for whom this issue is potentially important, it is going to be difficult for you and your advisors to decide what to do. Now, minimally, what I would recommend you do is at least talk to your advisors and investigate the issues and what might possibly be done. I think the worst thing you can do is just ignore it, and then something changes, and in retrospect you realize, well, I could have done something to make my position better, but I didn't. So you may review things and just decide you're not going to take any action. Okay, that's fine. But at least you'll have made a positive decision rather than letting events overtake you. So what I'm going to talk about now are some of the strategies that can be used to minimize estate taxes. So currently these are being used obviously by just the 4,000 or so estates that are, likely to be taxed. But that number, if just the 2017 legislation expires, that number is, like I said, is going to more than double, and so it's going to become relevant to a lot more people, number one. And as advisors, we need to have it on our radar. So I know I'm dealing with a situation like that right now, where we meaning the advisors on the estate planning team, met with the client last week to talk about these and generate some ideas about how we might handle the uncertainty and the risk going forward. So I'm going to talk about 5 common strategies. And I'm looking at my thing here for some reason. There's some weird. Oh, I see what it was. For some reason, this one didn't change. I have my notes here, and it went from 4 to 7 and then back to 6, which is weird numbering. So I'm gonna, like I said, I'm gonna talk about the 5 strategies that you can use. I'm going to mention a couple of others. The other ones are rather complex, so I'm not going to get into the details of them. Okay, so first of all, number 1, I mentioned the estate tax exemption. Excuse me. It's terrible having postnasal drip. That's all I can tell you. So so first of all, if you fall under the estate tax exemption limit, so then you don't have a problem, as I mentioned before. Now, if you're a married couple and therefore qualify for essentially double the limit. So let's look at next year, where the limit for married couples is just about $28 million, projected to be just about $28 million. Well, let's say that one spouse dies, but only uses 10 of his $14 million exemption. So his spouse, due to something called portability, gets the benefit of the $4 million in unused exemption. So going forward, the spouse, if we're talking about a he who died, if she supposedly, I guess, or I guess now with same-sex marriage, it could be either. But anyway, if he dies, his spouse would still have available $18 million in estate tax exemption. And again, that's the portability rule, whereby the surviving spouse gets to use any unused portion of a spouse's estate tax exemption. So that's one thing you can look at. How will that affect your estate going forward? Now, under the projected lower limits starting in 2026, where the limits are 7 and 14 million. Again, this is projected. We don't know for sure. So presumably, well, not presumably, portability will still exist. Okay. So if a spouse under the 2026 estimated limits uses only $5 million of his estate tax exemption, so that his spouse would have $9 million available under portability, because the $2 million unused would attach to the surviving spouse's $7 million for a total of $9 million. Okay, so portability is one thing that you can take advantage of. Okay, number 2, you can make lifetime gifts. So currently, each individual can give an unlimited number of gifts, up to a maximum of $18,000 a year. And those gifts then will not be included in the value of the estate. Okay, so let's say that you have an estate worth $1 million. Well, $1 million doesn't matter because it's not taxable. Let's say you have an estate worth $30 million. Okay. And so you're roughly $2 million over the 2025 projected limit. So one thing you could do is make a number of $18,000 gifts. And by the way, that limit is projected to increase to 19. I'm sorry, not did I say 18 million? Sorry. You can make a number of $18,000 gifts, and that limit is projected to increase to about 19,000 next year, and to a number of recipients. So if you did, let's say, 10 of them, that would be $180,000 that had been removed from your estate, and so that would reduce the taxable amount of your estate by the same amount, and you would save the 40% marginal tax on that part of your estate. Now, by the way, if you're a married couple, so each one of you can give $18,000. So in other words, a total of $36,000 this year, or potentially $38,000 next year. So if you have 3 children and you give, as a married couple, you give each of them $36,000. So that right there is going to take $100,000 out of your estate. If you do it for 2 years, that'll take $200,000 out of your estate. Okay, so you can consider using the annual gift tax exclusion. Okay, and that is one way of starting to transfer your wealth in a way that will ultimately reduce your estate tax liability. Now, one of the things mentioned in the Wall Street Journal article is Senator Elizabeth Warren is considering legislation to reduce the annual gift tax exemption to $10,000 and limit the number that anyone can give in any one year to $20,000. That would be a very, very drastic cutback from what is currently allowed. And it's, to the best of my knowledge, Democrats in general have not opined on whether they support this idea by Senator Warren. But again, on the other side of the aisle, to the best of my knowledge, no Republicans are suggesting anything in the annual gift tax exclusion, which is, by the way, indexed for inflation. That's why it went from I think it was $17,000 last year. It's $18,000 this year, projected to go up to about $19,000 next year. And it will continue to increase as inflation increases, right? So it's a tremendous benefit. And by the way, in the annual gift tax exclusion is a benefit even for people whose estates may not be subject to estate taxes, because it does give you the ability to transfer some of your wealth prior to your death in a way that could potentially benefit your children or other people. Okay, so by the way, a gift can be given to anybody. The person does not have to be related to you. So if you have a friend, for example, you can give that person money up to the annual gift tax exclusion, and neither you nor the other person pays taxes on it. Okay, that's the benefit. So again, another way of avoiding estate taxes is to use the annual gift tax exclusion. The next way is to set up an irrevocable trust. So there are several different types of trusts. There's something called an ILIT, an irrevocable life insurance trust. There's a grantor retained annuity trust, and a qualified personal residence trust. I'm not going to get into the details of these trusts. What I am going to talk about is irrevocable trusts in general. Now, when you set up an irrevocable trust and transfer assets to it, what that does is it pulls those assets out of your estate, and they are legally owned by a separate entity. Okay, so one of the ways of dealing with having to pay estate taxes, let's say you have a $50 million estate. Okay, so unless the estate tax is done away with, or the estate tax exemption is significantly increased, with a $50 million estate, even if the 2017 legislation is extended, you're still going to be subject to estate taxes. So, like I said, next year, the exemption is projected to be about $28 million for a married couple. So you can see a $50 million estate could still be $22 million of that estate could still be subjected to estate taxes, roughly at roughly a 40% rate. Now, the rate is stepped, but it steps up pretty quickly. And so on $22 million of taxable value, the estate taxes are going to be somewhere between probably about $8 and $8.5 million, maybe a little bit more. In other words, on a $50 million estate, roughly 16% of the value of the estate is going to go to estate taxes, assuming it's owned by a married couple. Now, by the way, if that estate were owned by an individual, so $36 million of that estate is going to be taxable. So that's roughly between 14 and $15 million. And so now we're talking about closer to 30% of the value of the estate being lost if there's no provisions made to pay the estate taxes. Okay, and that's why the estate taxes are such an important issue. Let's say that $50 million estate is comprised primarily of a business worth $50 million. Maybe the business is worth $45 million. There's another $5 million in assets. So even if you sold the entirety of the other $5 million in assets, there's still more taxes owed. And so now the business is faced with either A, borrowing money, or B, being sold in order to pay the estate taxes. And this is the burden that estate taxes creates, and especially if it's an ongoing business. So, putting debt on a business can be difficult, especially if it operates on small margins. Okay, so that's why this is such an important issue. So one of the ways of dealing with this is to create an ILIT, an irrevocable life insurance trust. And what that ILIT does is it buys life insurance that provides liquidity for the estate to pay the estate taxes. But because the life insurance is not owned by the estate itself, the value of that life insurance is not included in the value of the estate. Okay, it has to be an irrevocable trust. Okay, because that takes control of those life insurance proceeds out of the estate of the person who's died. Okay, I'm giving a relatively simple example. Okay, and as you can imagine, the cost to pay the premiums for that life insurance policy are significantly less than the proceeds of the policy if it ends up having to be used. Okay, so you might end up paying $1 million premium for, let's say, a $5 million insurance policy. I'm just making up numbers. Nonetheless, you now have $5 million available to pay taxes at a cost of only $1 million. Okay, so you see how the ILIT works, right? So again, a third way of minimizing estate taxes is to set up an irrevocable trust of one type or another. Okay, number 4 is charitable giving, and you see a lot of people look at this. So you can leave part of your estate to a charity, and generally speaking, those donations to the charity, number one, they transfer the wealth out of the estate And number two, they're tax-free, both for the donor and obviously for the charity, which is a nonprofit organization. Okay, and there are different ways to do it. There are things like charitable remainder trusts. There are donor advised funds. Again, I'm not going to get into the mechanisms. Hopefully we'll get a lawyer on who can talk specifically about the details on some of these. As you know, I'm not a lawyer, so I don't want to start, getting into all the, the individual legal issues. But again, another way to reduce your taxable estate is through charitable giving. Now, by the way, you can set up a foundation. And again, if that foundation is separate from your estate, that will remove assets from your estate and lower the taxable value. Okay, so there's and we think of like foundations as having hundreds of millions of dollars, that kind of thing. While that's true for big ones like the Pew Foundation and those kind of things, there are there are ways to create a smaller foundation. So, for example, here in Los Angeles, we have something called the Jewish Community Foundation, I think it is. It's part of the sort of larger Jewish social services that exist in LA. And within the umbrella of this foundation, a person can set up a smaller foundation that then is administrated by, we call it the foundation. So it's administrated by the foundation, and because they're administrating a whole bunch of them, they can do so in a very economical manner. And so, you could set up a foundation with maybe $5 or $10 million, and still, you don't have to worry about hiring a full-time manager, which would dramatically decrease the funds available for making charitable contributions, and so it becomes a viable foundation at that point. So again, a number of ways to do charitable giving, and so this is something for you and your advisors to take a look at, or if you're an advisor, to look at with your clients. Okay, another way of reducing tax liability is proper titling of assets. So look at your beneficiary designations, look at your asset titling, and in some cases, you may be able to move assets outside of probate and outside of your trust in a way that would minimize their estate tax exposure. Now, this is an area where you're going to want to have an accountant involved, and not just any accountant, an accountant who really knows estate taxation, because just because something doesn't pass through probate or isn't transferred through your trust, that doesn't mean necessarily it escapes being included in the value of your estate. But there are things like joint tenancy with right of survivorship, death on transfer designations in accounts that may allow assets to be transferred, for example, between a husband and wife, in a way that perhaps they're taken out of the husband's gross estate or taxable estate when he dies, and thereby leaving more of his estate tax exemption to port over to his wife or to his spouse. Okay, so this is a very high level of estate planning, and it's one that will require not just legal but also accounting advice if the lawyer you're dealing with doesn't really know the intricacies of estate tax accounting, and many do not. They know how to create the entities and advise on the entities, but they work in a team with an accountant to make sure that clients get the best possible advice and get the best possible plan. I know that's how I work in my business. I work as a team. So I don't advise on law. I don't advise on accounting matters. I advise on administrative matters because that's what I do as an independent trustee or as an independent administrator. Okay. And all of those various aspects are important. So if you are considering, for example, creating an irrevocable trust, who are you going to appoint to administrate that trust? Okay, because it probably can't be you, because if you're administrating the trust, even though it's a separate entity, if you're administrating it, the IRS may consider that to be too close, and so they may impute the value of the trust asset to your estate. Okay, so all of these things need to be looked at again from a legal, accounting, and administrative basis, all three of those aspects. Okay, so those are the 5 primary ways that you can look at minimizing estate taxes. There are a couple of others that are beyond the scope of what I'm going to talk about today. One is using family limited partnerships, where you have multiple generations of a family in a limited partnership that owns property, could own a business, could own investments, real estate, in such a way that maybe the older members retain control of the assets, while the younger members, who are the heirs, they get the benefit of inheriting the assets, and because it's a limited partnership, valuation discounts can be used in such a way that will minimize estate taxes. So that's something sophisticated to look at. In that case, you would also want to probably have an appraiser involved, because because the kind of valuation discounts that you can take, almost for sure the IRS is going to want to see actual appraisals on that from qualified appraisers, meaning appraisers who are licensed. And so you're going to want to have that input as well. And then finally, there's something called a generation skipping transfer tax exemption. And to be honest with you, I don't know a whole lot about it. I've heard of it. I haven't really looked into it, but I did think I did want to just mention it, so that if you're talking with your advisors, you can say, well, what about a GST, a generation skipping transfer? Is that something that would work? Obviously, that won't work if you don't have grandchildren, but if you do have grandchildren, so you may be able to skip a generation and make your grandchildren directly your heirs, at least for some of your assets, and there could be some estate tax minimization that comes from doing that. So, in summary, and this is where I started. Plan ahead, okay? I think the worst strategy you can take is to ignore what may be a significant change happening after next year. Now, by the same token, we don't know what the change is going to be, and so you may be reluctant to spend a whole lot of money or create irrevocable trusts and all that kind of thing, only to find out that maybe you didn't need to, or B, you now you don't have control of those assets anymore, and you sure would like to have control over them. These are the pluses and minuses, and weigh the risks, weigh the costs, and you'll have to make a decision. But at least you'll be making an informed decision, and so that's why if you have an estate, if you have not begun your estate plan, begin it now. Okay, you may think, oh, I've got lots of time before the end of next year. That time can go very, very quickly, especially if you have a larger estate, and if you're kind of on the cusp. So if you've got, for example, if you're single and you have an estate that maybe is worth $7-8 million, you're right on the cusp. If you have not begun your estate plan, do start, today. And likewise, if you're a married couple and you're around 13, 14, 15 million dollars, start today. If you have an estate plan already in effect, so now is a good time to do a review. Okay, by the middle of next month, all the tax return filings that were put on extension, they have to be filed. Okay, and so accountants will have a little bit of extra time. You'll still have time to do some end of the year transactions if you need to. Okay, that would make your position better if you decide that's what you're going to do. And if you are going to set up any kind of entities, trusts, or family limited partnerships or whatever, you'll have time to do that moving into next year, so that you're not pressed by waiting until late summer, fall of next year, and now you're really time crushed because everybody's trying to get these things done, and there's just not enough hours in the day. Or your advisors are really pressed because they're under pressure from a lot of clients and they end up making a mistake. All right, so like I said, now is if you haven't already done it, the next best time to start your estate planning is right now. And so I encourage you to do that. To that extent, if you need a referral to a lawyer or an accountant, please feel free to reach out to me. I work with a lot of professionals in this area, and I'm happy to give you a recommendation, so that you're not just sort of pulling someone off the internet. Or talk to friends and family members and see if they've used someone that they recommend. But by the way, it's perfectly appropriate to interview more than one lawyer, more than one accountant, before deciding who you want to advise you. You do want someone who's a fit, and who understands your perspective. And so, by the way, if a professional is going to charge you for an initial interview, so exclude that person. Okay, just exclude that person right off the bat. No lawyer or accountant, or for that matter, administrator, should charge you for an initial consultation to decide whether you want to engage that person. And so talk to them. Have a list of questions to discuss, to get their perspective, get a sense of how they work, whether personalities match, et cetera, et cetera. But like I said, the worst thing you can do is just ignore this and decide, oh well, it'll all work itself out in the wash, kind of thing. Not likely to. And of course, the larger your estate, the more you have at stake and the bigger the potential loss. So, it is something to get on right now. If you have questions, comments, negative, positive, please feel free to put them in our social media. Always look to always enjoy seeing those and look to respond to them. And if it's anything of a personal nature, like a referral, my email address will be there as well, or you can direct message me. I'm happy to communicate with you that way. And then one last thing before I sign off, or two more things before I sign off. If you're not a subscriber to the show, please do consider subscribing. It's real easy to do on YouTube. Just go to our YouTube channel, youtube.com/@the-way-to-wow. And you'll see you can subscribe, and that way you'll get a notification every time we go live, and you'll never miss a show. And then let's see, tomorrow at 10 a.m. These are all Pacific time. I have a special edition. So tomorrow is Citizenship Day, formerly known as Constitution Day. And so we're going to have a special show featuring a history of the U.S. Constitution and a reading of parts of the Constitution. So I hope you'll join me for that. And then on Wednesday at 10 a.m. Pacific time is our monthly feature, Economic Echoes, where we talk about how changes in the economy affect us as individuals. So for those of you who've seen one of those episodes before, have heard me talk about them, we don't live the national economy. We live within it, but the way changes in the national economy affect us depend on the specific decisions that we make or we and our families make. And so we dig down into the data to see, why does our economic life seem to be perhaps different than what we're reading in the news or what the national statistics seem to be indicating. And then, of course, 7 days from today, I'll be back with the next edition of the Way to Wow show. And my guest is, for return engagement, is Hillary Cooper of Uncluttered. And we're going to take our next step on this journey of what do you do with the stuff that decedents leave behind. So, I hope you will tune in and watch and listen to Hillary's and my next discussion as we go more in depth on this topic. Right? It's just the amount of stuff just gets overwhelming. So how are we going to handle that? And that wraps it up for today. So thank you so much for watching. I really appreciate it. And look forward to seeing you again later this week. Signing off as I always do. Marie, darling, you are my bell.